So we'll begin now. Thank you very much for joining today. We are going to talk with Adrian about the oil and gas sector, and more specifically about the last publication that our research team has published a few weeks ago. Before, we are going to go through a little introduction of Carbon for Finance and talk about our expertise. And I will let also, of course, Adrian explain the results of this research paper. I'm myself, Melissa Perez. I'm Head of Sales and Business Development at Carbon for Finance. Who is Carbon for Finance? Where we are coming from? I think it's an important beginning of this story to talk about our expertise. So Carbon for Finance, we are coming from a group which had more than 70 years of experience, which is the group Carbon 4. The group Carbon 4 has been founded by Jean-Marc Jancovici, which is the founder of the bilan carbon methodology, and an economist, Alain Grandjean. In 2016, they have been requested by some actors such as Mirova and Euronext to create a climate, and at the time only climate, but now biodiversity data provider specialized in metric for financial sector. It was not enough to only accompany the corporates on their understanding of their transition risk, to help them on their strategy regarding climate change. What was important for financial sector, it was to be able as well to have comparable and also scientific based data to be able to know where rely their transition, their physical risk, be it for climate and for biodiversity. Since our creation, we have developed now 3 databases. The first one is called Carbon Impact Analytics, and this is the one we are going to talk about today. We have the calculation of the scope 1, the scope 2, the scope 3 with a bottom-up approach. The second one is called PRIS, and it's a methodology and database about physical risk. And the third one, co-created with CDC Biodiversity, is a database on biodiversity risk and impact. Our specificity is what Adrian will talk about, is the bottom-up technology. It means that for a certain company, we are going to look not only what is reported, but also to recalculate their scope 1, their scope 2, their scope 3, induced and avoided using emission factors that are sometimes proprietary at Carbon 4. And that's very important. Today, we talk a lot about the CSRD, the transparency. Unfortunately, CSRD is very good for transparency, but does not allow financial actors such as you to compare on the same basis different types of corporates, because there is this concept of materiality, and hence each company can decide to report on certain parts of their scope 3. So if we go on the next slide, we have our approach, which is a robust and scientific and transparent approach, and our 2 partners, I would say, which are Carbon 4 Advice and CDC Biodiversity. Today, the fact that Adrian is here is what I say is a daily basis of what our client can ask. All of our client base, which are financial institutions, and today as well corporates, can ask to have a direct contact with the research team with no limit on the question. And I hope that today you will have a lot of questions for our experts on oil and gas specifically, but more broadly, if you have any question on the methodology as well itself. If we go on the next slide, if we talk a bit more about our coverage, because it's important for financial actors, we cover all of the different types of asset classes, be it listed corporates, as what we are going to see today, but we cover as well sovereign bond, green bond, loans, private equity, real estate, and infrastructure. And this data can be used by financial actors, but we decided as well to now propose it as well to directly corporates if they want to know their rating and compare themselves with their peers in terms of climate benchmark. Last but not least, and promise we are going to talk about oil and gas, if we speak a little about our client base, so we have different types of actors, be it asset managers, asset owners, banks, that also index provider, and we are also the official climate data provider of the Euro system. So all European Central Bank use today our data on climate, so the data you are going to see today. And if we finish with now the client that use our database on biodiversity, we have been a pioneer on this topic as well with the help of CDC Biodiversity. And we have now a broad range of clients in France, but also abroad. In France, for example, we have Odo, OFI, and all the group Crédit Mutuel and all of their subsidiaries. But also abroad, we have, for example, ING or Vontobel Asset Management Growth Boutique in the US. And I think it's very important. We are today proud, I will say, climate and biodiversity French data provider, but we provide our data worldwide, and you will see with the data on oil and gas, our coverage is also international. I will let now Adrien present to you the results of this story. And if you have any question, I will look at it on the Q&A part. I see specifically that Denis might have a question, and I will ask you maybe to ask it on the chat or on the Q&A session. Thank you.
Thank you, Melissa, for the short introduction. So on to me to present to you the results of the study we have been conducting over the past few months. Actually, over data from the previous campaign we conducted in the oil and gas sector. I was in charge of this campaign among a team of around 20 or 25 analysts, which I have followed throughout the year. I would like to start this short presentation with an overview of the sector, see how the sector performs in terms of climate performance and in terms of transition risks. So I think that it is important to first remember and remind you of the evolution of our global energy consumption by type of energy over the years. This graph, what it shows very well is that our consumption of mainly coal, gas, oil has risen steadily and very sharply over the past years. And among them, oil and gas constitute the biggest share of this increase. And today we'll focus on these types of energy. Other methodologies of carbon for finance focus, for example, on coal or renewables or nuclear. In this case, I just would like to remind that the scope of this analysis is done on oil and gas. So where does the sector stand in terms of climate transition? Well, first, it's interesting to note that for both oil and gas, the consumption, as I've shown earlier, has steadily risen since 1990 and even before. So the point where we stand now is at the end of the dark blue line, and the red, light blue, and green line show different evolution of the consumption of oil and gas in scenarios from the IEA. So for those of you who don't know the term yet, IEA is the International Energy Agency. It's known as a robust source of scenarios for the climate transition, NZE 2022 being the most ambitious scenario from the IEA. The NZE scenario is supposed to allow us to stay below 2 degrees, have at least 50% chance of staying below 2 degrees at the end of the century, whereas the APS and the STEP scenario are much less ambitious and are not normative in the sense that they follow what has been taken, political decisions that have already been taken. This is to show that if we are to follow the NZE scenario, there needs to be a drastic reduction in hydrocarbon consumption as a whole, be it for oil and for gas. And it's interesting to note that actually the sector needs to have a big to lead a large transition to meet these objectives. How does it compare to this today? Well, what we see is that globally the oil industry, and I will delve into the results a bit later, but it is actually moving in the opposite direction of climate targets and objectives. So if we look at the global hydrocarbon production trends for both the NZE trajectory from the IEA, which I've shown earlier, and the 1.5 degree trajectory from the IPCC, what we see is that the trajectories decrease the consumption of oil and gas very rapidly over 2030 and 2050. What is interesting to note in this graph is that actually all new fields, and this is what the IEA has repeatedly mentioned and said and reminded, is that all new fields of oil and gas are above our climate objectives of meeting the 1.5 degree and even the 2 degree trajectory. So this, I think, is a key figure to understand where the oil and gas industry stands today and where it needs to go to put itself in line with our climate objectives. If not, the sector is really at risk of missing its transition and of actually locking us into warming trajectories that are above levels that are acceptable. And it is important for the sector to transition because with the CIA methodology of carbon-forward finance, we mainly look at transition risks. So transition risks are of a lot of different natures. They can be policy, market, technology. For example, the increasing price of greenhouse gas emissions can be an important transition risk for those companies. But the difficulty in receiving financing, for example, from investors is another one, or the substitution with lower emissions technology also represents one of the main risks for the sector, as well as changing consumer behaviors, for example. So how does our methodology, the CIA methodology, carbon impact analytics, apply to the oil and gas sector? Well, I will strive to explain that right now and show how we apply our methodology, our notation to the oil and gas companies. Well, first of all, as Melissa mentioned earlier, we rely on a bottom-up approach, meaning that we use physical fluxes. So, for example, tons of petrol or barrels of crude oil or the quantity of megawatt or physical quantities, whatever they may be. And this allows us to evaluate the transition risks of different companies, meaning that computing intensities, for example, we can see how companies compare to each other based on physical data. And we also compare next to that not only the past evolution and the current performance of companies, we also look at their strategy, their future strategy, their targets, be it on scope 1 and 2 emissions or scope 3 emissions. And we provide a carbon footprint of each of these companies, specifically on scope 3 emissions, as well as on avoided emissions, which represent the contribution of the company to the low carbon transition. So as for the oil and gas sector, the methodology covers the entire value chain, which I will quickly describe here under. We have companies that are specialized in upstream exploration, production of oil and gas, companies that specialize on midstream, transport, distribution, storage, and companies that also specialize in refining, for example, or supply of these products. Some of the companies are independent, so they work and their activity is only at one stage of the value chain. I show examples here. And we have integrated players, what we call integrated players, the ones that are most familiar to us, such as the European majors, as well as the American majors, ExxonMobil, Chevron. And finally, we have intermediate actors, which are mostly involved in trading, and which will slightly leave apart in today's presentation, because their levers of transition are also a bit different. So as Melissa mentioned earlier, as you touched upon, what we strive to do with the CIA methodology is to establish an order of merit between the companies of the sector. To do that, we base our calculations on 3 pillars of performance. We use the past performance of the company, which shows the evolution of the company's emissions trend over the past 5 years on both scope 1 and 2 and scope 3 emissions, which allows us to understand the full value chain impact of the company. We then look at the present performance of the company, which is its scope 3 intensity, meaning that a company that is more exposed to heavier and more greenhouse gas emissions intensive products will receive a worse present performance score. And finally, we look at the future performance of the company, meaning that we analyze its decarbonization strategies, how it aligns its activities to a low carbon transition, as well as its commitment, its governance, et cetera, et cetera. I will deep dive into that a bit further on. And of course, what we want to stress is the fact that companies of the oil and gas sector cannot themselves contribute to the low carbon transition if they don't shift their activity. So we attribute a cap and a floor to these grades, meaning that a company that will receive that a company from the oil and gas sector cannot receive a score that is higher than 8, 8 being one being the best score and the 15 being the lowest score, except if it changes its activities, in which case it can actually receive a score which is higher than 8. It's important to stress this out because companies from the oil and gas sector in themselves cannot contribute to the transition without shifting their activities. On we go. So one important figures which we have put forward in our application, our study, is that over the past 5 years, volumes from the oil and gas companies which we have analyzed, so approximately 150 companies of the sector, which are private company reporting public information, the volumes have increased by 31% over the past 5 years. So I pointed forward some companies' name here, showing the evolution of their volumes. So some of them you might recognize, but some companies you might not recognize, specifically those on the far left side. We have companies that have increased their volumes by approximately 200% over the past 5 years, which is enormous. Those are mostly companies from the Permian Basin in Texas in the US, which are active in shale oil exploration with really an increase and a boom of their volumes of production. And they represent smaller actors which show a different trend from the rest of the sector, in which are a bit separate. So this is how we apply the past performance. We look at the evolution of the company's absolute scope 1 and 2 and 3 emissions over the past 5 years. This is just to show an example. We then look at, as I mentioned earlier, for the present performance, at the scope 3 intensity of the products that are sold by the company. So for example, if we take ExxonMobil, which is one of the largest actors of the sector, it sells, explores, and transports more liquids than gas, meaning that its average carbon intensity of its products is 2,860 kilograms of CO2 equivalent per ton of oil equivalent, compared to, for example, Eni, which has a lower carbon intensity because it is more geared towards gas than liquids, and even more if you look at Gazprom, which is mostly focused on gas and very little on oil in the end. And then we look at the strategies of the largest companies in the sector. How do they compare? So if we give a small example of the five of the biggest oil companies in the sector, we have BP, Eni, Total Energies, which are all 3 of them European companies. Then we have Exxon, an American company, and Saudi Arabian Oil Co., which is the largest private company in the sector. If we compare the strategies of these companies, we see that BP, at the time of this analysis, had a more ambitious strategy of reducing its scope 1 and 2 emissions, reducing its hydrocarbon volumes. Whereas, for example, at the opposite, we have Saudi Aramco, which has not set a scope 3 emissions target, which has set a very not ambitious scope 1 and 2 emissions target. We then look at their low carbon investments. So we strive to find quantified figures in their reports, showing their share of their capex and their expenditures that they dedicate to the low carbon transition, specifically renewable energies, biofuels, green hydrogen, et cetera, et cetera. And finally, another element that we look at, even if they do not represent all elements, is one of the main elements for oil and gas companies is the scope 3 emissions reduction target. An oil and gas company that doesn't set an ambitious scope 3 emissions reduction target really fails to grasp the most important points of the transition, and as such, we give it the worst score, because it means that essentially the company is not ready yet to reduce its volumes. Whereas, as I've shown previously, this is what is commended by the IEA and basically all by the Paris agreements. What we see when we compare companies between, for example, different continents, is that European companies, on average, in terms of strategy, they're ahead of their peers. What this graph shows is that for Europe, you have here a small cluster of companies that receive rather good forward-looking performance ratings because they have set Scope 3 emissions reduction target, they have set targets to develop renewable energy, et cetera, meaning, of course, they're not perfect at all, and their strategy lacks a lot of ambitious targets to really be in line with the transition. But again, what we strive to do is to establish an order of merit, so and compare companies between them within the sector, not across sectors. Whereas if you look at, for example, North America or even Asia, most companies receive weak performance ratings in terms of future of forward-looking performance because their targets are not ambitious and not in line with the climate transition. And what I wanted to stress here is that we covered approximately 150 companies. So here is a sample of the scores we gave to the company. So what you see is that the best company here is involved in oil and gas, but it is also involved in other activities such as biofuels production, for example, which allowed it to receive the best score of our sample. And at the opposite side of the sample, we have this company here, which received a score of almost 14 out of 15, which is only dedicated to oil and gas, and which clearly has no strategy to transition. This is just to show the variety of companies within the same sector and why it's important to establish this order of merit. So now I wanted to illustrate my my wordings with this short case study. In this case, we will take the example of TotalEnergies, the European major, the French, one of the largest French companies. And what I found interesting is when we analyze TotalEnergies is there is a lot of communication around the development of renewable energy, low carbon solutions, which, as I've shown earlier, is one part of their strategy, and which is positive, and which we actually note as positive. But we also want to show here that what I will show later is that it's only part of its business, and it's important to put this in perspective. We have a lot of elements of communication on the climate transition. What we see as of today, and what's interesting with the methodology we apply, is that it allows us to see where the revenue streams from the company come from, and actually which implies where its transition risks are. As of 2022, TotalEnergies had a lot of its revenues, approximately 99% coming from oil and gas, and approximately 1% from power generation and supply. This is how we score the different activities. So obviously we will score the activities of the company differently depending on the type of activity. So for oil and gas, we gave a score of 11.5 based on these elements, the evolution of its volumes over the past 5 years, as well as its average intensity. And we gave the score of 6 over 15 and 4 over 15 for the current performance for the power generation electricity, with approximately 1/3 of the electricity generation coming from renewable energies and the rest from gas. And one of the last parts I wanted to delve upon is where does the sector and where do we go from here, having these keys in mind? What are the next steps? So what I've seen over the past year is that companies from the oil and gas sectors have recorded have made record profits, which in a sense have jeopardized their energy transition. I show here 2 examples of BP on the left, which with Bernard Looney, their ex-CEO, as well as of Shell on the right with their current CEO, Wael Sawan, who have both made declarations that are, I think, very interesting and are keys to understand where the sector goes from here. What's interesting to note is that BP in 2021 had a strategy to reduce its volumes by 35 to 40% by 2030. With this target in mind, BP was amongst the most ambitious companies of the sector. It still remains one of the most ambitious, but it has reduced its target. It has reviewed its target rather to reduce its volume by 20 to 30% in 2030 compared to 35 to 40% before. As to the reasons of this change, multiple hypotheses can be made, but basically, what we know and what we know for sure is that the high prices for oil means that it's more competitive for companies to invest in oil and gas rather than renewable energies, which become competitive but are less so than oil still. As for Shell, it used to have targets, or at least it expected to reduce its oil production by around 1 or 2% per year, whereas new declarations 2023 have stated that the company will not reduce its hydrocarbon production until 2030, and that it will actually invest more in oil and gas and less in renewable energies. And I found this particular case very symptomatic of the climate transition. And as I've stated earlier, in 2022 and 2023, big oil meant big profits. In 2022, and this is also the case for 2023, the 5 majors of the sector have made record profits, which have never reached before. We have seen record shareholder payouts. This was year to date on Q3 2023, meaning that it reached above 2022 probably. And what's very interesting to show is that this is a graph from the IEA, International Energy Agency, that over the years, at constant value, the share of dividends and share buybacks, which are a means to remunerate shareholders, have drastically increased, whereas hydrocarbon investments have decreased. And what we see appearing more is in 2021 and 2022 is debt repayments, meaning that companies are rather comfortable with their cash. They have enough to repay their debts, whereas on the other hand, low carbon investments, which we see in green, represents approximately 1% of the sector's investments in 21 and 2022. So big profits don't necessarily translate into more investments in renewables and into climate transition, but rather into short-term revenues and returns for shareholders, as of today at least. And I would like to finish off this presentation by an interesting case which I've read upon is could the fiduciary responsibility appear as the Trojan horse of transition? What we see if we look at the performance of the oil and gas sector in the S&P 500 index is that it has underperformed its peers. It's here in light blue. Compared to other sectors, it really has underperformed. And another important point is that what we've seen, what studies show, is that actually since 2014, between 2014 and 2024, actually the fossil fuel industry has underperformed the rest of the S&P 500, which is a highly diversified index, and meaning that if we just think about fiduciary responsibility, the fossil fuel industry could be a bad bet, especially in times of uncertainty and high transition risks. These companies could really pay a huge price if they do not make their transition soon. And my closing word would be to say companies from the oil and gas sector need to diversify to change, else they will die in a low carbon world. And that's it for me. And I'm really happy to hear if you have any questions or remarks or thoughts.
Okay. Thank you very much. So it's your chance. If you want to ask last question, it's now. Else, we will provide you our contact, our email address, and you can still contact us to have more information on the rating, the methodology, be it on the oil and gas sector or on the other 63 sector that we are covering in depth as well. Okay. Thank you very much for attending today. It was a pleasure. We will send to you in a few days the replay of this video. And don't hesitate to reach out if you have any more questions. Thank you very much.
Thank you very much.